We've coined a new term this quarter for the top 30 or fast 50 US equities pairs, and these ones are called the slow 60 for the September vintage. And why is that? Well, we've added 10 new pairs, and I'm going to take you why we call them slow in a second. But first, if you're not aware, these are pairs that when you open PairTrade Finder Pro, you go to Systems Preferences, Autoload tab, and just click on the button Autoload US Equities Pairs. And PairTrade Finder Pro will pull these down off of our server, upload them into my watch list, and here you can see some of them. And these will immediately begin calling high probability pair trading opportunities for you to review and study, and if you like them, potentially trade. So let's just go into a bit more detail about what we've done for you. So what can we do for you? We make pair trading stocks easy. Besides our video training course, tutorial videos on every aspect of the software, our Trade of the Month blogs, and our ebook that we send you when you sign up, we do the hard work for you to learn to become a consistently profitable pair trader. That's our commitment to you, that you'll get consistently profitable in 30 days if you do the work. So in addition to all of those things above, we handpick and then allow new subscribers to autoload into PairTrade Finder Pro 60 of our top stock pairs. These pairs will generate immediate trading signals, and we call them the slow 60. Then with PTF Pro, you can semi-auto trade these signals directly into Interactive Brokers Trader Workstation as a pair trade order type. It's one-click execution. Or if you prefer, you can receive these signals by email and trade them into any brokerage account you use. So what is it all about, the slow 60? As we say, it's a curated set of 60 USA stock pairs. We generate these over hundreds of hours of backtesting, profitability filtering, and fundamental screening of over 2,200 companies. Basically, we do all the hard work for you. There are, in this list of 60 pairs, there are 43 industry subsectors, so there's a wide diversification. The pairs we screen also for volatility, and most of them have volatility under 3%, and all but one under 4%, which is sort of our cutoff before we would reduce position size to about 0.5%. So please, half position size. So please watch your position size when you trade them. There are no repeated tickers. Again, diversified. You're not using the same symbol in different pairs. And autoloaded into PairTrade Finder Pro when you subscribe. These were launched to our members on 29th August, about 4 or 5 days ago. And you can see our pair selection criteria if you go to this link here. Let's just take quickly through the backtest results. So this is in-sample backtest last 12 months. There were 134 trades, over $36,000 of profit. There were 132 winners, 2 losers. That's a 99% win rate. Biggest winner was almost $1,100. Biggest loser was about $200 loss. Average win was $275. Average loss was $100. Reward to risk was 2.8 times. The average days in trade, because these are slow 60, was about 21 days versus about 15, 12 for our previous sets. Longest trade was 64 days. That would have been a time stop that was called. And the shortest trade was 3 days. So this is how we impute the returns. When we talk about, we assume that you've got about 21 days in a trade and about 11, well, we round that up, so let's say 14 trades capacity at any one time. And so for that, if you're trading at $5,000 a leg and 5-to-1 CFD margin at IB, you'd have 140,000 notional. You would require equity of 28,000 to hold that. We add in some headroom here to make sure you could take extra trades if they come in a series, and that's about 25% headroom. That means we impute an account equity of about $35,000. And the net profit after the cost of the margin was about almost $3,000 at today's rates. That's 3.83%. You still made almost $34,000 on this $35,000 balance. That's almost doubling your money, 96% per annum, about 6% per month. And the S&P index over that same LTM period was down 8.7%. So your alpha generated in the backtest by these 134 closed trades was over 105% versus just buy and hold. So that's what it's all about. And why do we call them the slow 60? This is important. We want to understand you to understand how we think about trading and volatility. So the summer has been a period of very low volatility. This was the beginning of July. And you can see that the market became incredibly complacent. And if we were using 60-day lookbacks, this would be the look-back period where the Bollinger Bands are very tight around the moving average of the ratio. So when everyone gets back to their desk, as they are this week, we were expecting volatility to spike, and you can see here that's exactly what it's done. And what we wanted to do is protect you from some crazy wild swings that would put you into trades at perhaps not very good entry levels because those Bollinger Bands are so narrow. So we lengthened the look-back period to 100 days to try and reduce the sensitivities of the signal, and that's why we call them slow. And the average, we saw before, the average trade length in the backtest is about 23 days versus about 15 for our other sets. So let's go through an example. This is a really nice one from the set. This is Grupo Aeroportuario del Sureste against Grupo Aeroportuario del Pacífico. And you can see over the last 3 years, there were 7 trades. They were 71% correlated. Co-integration was almost perfect. The compound annual growth rate, if you just left this capital sitting there waiting for these trades, was 14.36%. Maximum drawdown was only 4.1%. They generated $2,600 of profit, about $2,500 after commissions. And so there were 100% winning trades, $350 per trade average. And these were quick trades. They were about 10 days on average. If you want to look at these, this is the fundamental screening. So both of these companies hold concessions to operate, maintain, and develop airports in Mexico. It's just that one is in the southeast region and one is in the Pacific region. So very similar companies. You can see here their betas are almost identical. Their enterprise values are very close, and all of their valuation metrics are pretty close. Like price earnings is 17 for both of them, EV to EBITDA about 0.5 for both of them. And Zacks ranks them both the same, 3. Their dividend yields have a bit of a difference, so you might want to take a look at that closely when you enter trades. Here you have the P&L curve. You can see all of these different trades, every one of them a winner, and very, very nice. Bottom left to top right, smooth equity curve, almost no drawdowns. And this is the ratio chart over those the last 2 years. So you can see a very flat ratio, not trending, lots of zero crossings. And here you can see every one of the entries and exits that led to these profitable trades. So that's an example of a slow 60 pair, and you've got 59 other ones when you autoload. It takes a lot of work to find these, as you can tell, and we think that's what gives you an edge.